The global economy enters 2026 on a firm footing, supported by widespread fiscal stimulus, monetary normalization, and accelerating AI-driven capex and adoption, factors that should underpin robust growth across most regions. The Fed has eased rates by 1.75%, but inflation remains above its 2% goal. While price pressures aren't accelerating, rising costs and margin strain could keep inflation elevated through 2026. With growth strong and jobs cooling gradually, the Fed is expected to move cautiously, aiming for a neutral rate rather than deep cuts. We anticipate 2 additional cuts this year, possibly earlier if unemployment rises. The focus for 2026: balancing steady growth with inflation control in an economy increasingly shaped by structural trends, not short-term cycles. AI-related investment has emerged as an additional pillar of U.S. growth. Technology companies are accelerating their investment in AI infrastructure to secure a leadership position in the AI-driven revolution, which is expected to unlock new revenue streams and enhance profitability. In the first 3 quarters of 2025, AI-related capital expenditure accounted for roughly 40% of GDP growth, slightly less when accounting for imported equipment. Even so, this represents a significant structural shift in the U.S. economy, with projections indicating AI-related capex could reach $1.3 trillion over the next 5 years. And providing the market narrative around AI does not take a turn for the worse, AI capex will likely have an expanding footprint in economic activity, remaining a key driver of U.S. growth. China remains a key catalyst, leaning on tech innovation and export strength to offset weak domestic demand and property stress. Europe benefits from fiscal easing, though faces risks from heightened export competition and mild deflationary pressures. Diverging global monetary policies add complexity. While the Fed cuts, the ECB may pause or hike, and Japan continues gradual tightening. Although US dollar is expected to stabilize, currency volatility may pick up, impacting trade flows. Catalysts include policy support, supply chain diversification, and tech investment. Risks center on geopolitical tensions, uneven recovery, and inflation surprises across regions. U.S. equities remain supported by a strong macro backdrop and a non-recessionary Fed cutting cycle, historically positive for risk assets. Technology should continue to lead, but scrutiny on AI-driven capex and valuations means earnings delivery is critical. Broader participation is likely, with financials and consumer discretionary benefiting from policy stimulus. Diversification is key. Small caps offer attractive valuations and rate sensitivity, while global markets such as Europe, Japan, and Asia provide opportunities. Europe's limited tech exposure and improving fundamentals make it a useful diversifier, but earnings delivery will be key. Japan's fiscal stimulus supports reflation, and Asia offers tech exposure at better valuations. Countries such as Taiwan and Korea will remain key beneficiaries of the AI capex. Despite AI bubble concerns, fundamentals remain strong, but concentration risk argues for a balanced approach across sectors, regions, and market caps. Despite easier monetary policy and ebbing inflation, fiscal sustainability concerns keep long-term yields sticky, driving gradual curve steepening. Fed cuts and asset purchases anchor short rates, but high-term premiums reflect lingering debt worries. Credit markets remain supported by strong corporate fundamentals and benign default risk, though spread compression for investment grade is limited, favoring total return strategies. High-yield issuance is robust, with refinancing risk minimal through 2027. Emerging markets offer relative value amid resilient fundamentals. Overall, focus on quality, duration management, and selective EM exposure, while balancing opportunities in credit against structural fiscal risks.